Hi, it's Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives. Last year, 2022, we saw record annuity sales across several categories. But now, nearly halfway through 2023, many of the same macroeconomic factors that drove sales last year are still present. And while it's too soon to say what 2023 annuity sales will look like, my guest today will share why annuities can be a valuable addition to a retirement strategy, regardless of market and economic conditions. Todd Taylor is the head of retail annuities at New York Life and the author of several pieces of research on retiree behavior. And he joins us today to discuss the often overlooked behavioral benefits of annuities. So, Todd, tell us a little bit about your career path, what led you to join New York Life, and a little bit more about your role there.
Great. Well, first, thank you for having me, Bob. It's wonderful to be on. I love talking about all things, retirement planning. So this is a lot of fun for me. I've been at New York Life for most of my career, the past 15 years. I'm an actuary by training, so I spent a lot of time kind of rotating around through a training program around New York Life and got to see life insurance side of our business, the annuity side, and some of the corporate functions. And through this process, I sort of fell into interest in retirement and retirement income planning and a stint in our annuity business, and it really stuck with me. So I spent some time doing research on the subject. I came back to annuities 5 or 6 years ago and gradually took over more and more of our business, and have been leading the entire business at New York Life for the last couple of years.
Well, let's start with some context. I know that New York Life was the number one seller of annuities last year, 2022. What drove that outcome?
Yeah, so it's a few things. And first, I'll say, industry leadership and being number one in the industry is not an explicit goal of ours. There's really kind of three factors that led to our success last year. The first is we take a purposefully diversified approach both to our product mix as well as to our distribution. So we like to have a product set and distribution that lets us compete in a variety of different economic environments. And so certainly last year was pretty unique, as I'm sure we'll talk about. But that helped in having that diversified set, to be able to compete in a bunch of environments. The second is, we're a AAA rated insurer, highest financial strength rating of any insurer in the industry. And consumers and advisors are often reminded of the value of financial strength as crises happen in the environment. We certainly saw this in 2008. We saw some of this last year where people are reminded of the value of financial strength as things are kind of going sideways. And then finally, the other one is, through some of our distribution partners, we've invested quite a bit in servicing capabilities, the ability to handle annuity volume at scale. And so as the industry increased so much in volume last year, our investments in servicing helped us stand out probably relatively better versus some of our competitors in being able to actually get the business processed and in the door. So those three factors drove a lot of our success. I will say, of course, as you know, the macroeconomic environment really was what was driving the entire industry. The industry was up 25% last year, largely on the factors that you know well: equity markets, interest rates rising, and just a lot of uncertainty.
Well, I will throw in a fourth factor, which I know that New York Life has a history that goes back more than 150 years. I know you've been in New York, where you're speaking from now, for over or almost 100 years. Let's talk about the macroeconomic factors that you just mentioned. I know that contributed to the interest in annuities last year. How is the market that we're seeing today similar or are there any key differences that you see that are impacting retiree behavior?
Yeah, so I think as you started, largely what we saw last year has continued into the first 4 months of 2023. The way I've described this to many is we've got a tremendous number of folks approaching retirement here in the U.S. or early into retirement, and they face the need to stay invested in equities to be able to combat the inflation we're seeing in the long run. But we've also seen equity markets declined. We saw bonds bond funds, go down for the first time in a generation last year. Uh, Interest rates jumped up, and so there's just a lot of uncertainty in the market. And a lot of the annuity growth really came from what LIMRA has called protected accumulation solutions, effectively annuity products that give you some sort of guarantee on your accumulation with a chance to earn the returns you need to fund a retirement lifestyle. And that's really continuing into 2023. I think the industry is up somewhere around 50% quarter over quarter in the first half of this year. But to your question on behavior, I think the biggest thing that we've got to take into consideration is, behavioral economics has led lots of folks to conclude that everyday investors aren't perfectly rational. It's like, traditional or neoclassical economics says that we all sort of operate like kind of automatons and everything's perfect. It's not really how people behave. And one, certainly the uncertainty in the last year has highlighted this. There's a lot of folks who've moved out of equity markets, put a lot of money on the sideline. And I think what this is highlighting is that, there's a lot of value in being able to provide both advice and also solutions to keep people steered towards what a long-term asset allocation mix should look like. And as I'll highlight, I think that their annuities provide lots of behavioral benefits in addition to kind of the traditional or kind of normative economic benefits.
You mentioned LIMRA, just so our audience understands LIMRA, and I think it has a sister organization, LOMA. Those are the trade organizations that represent the annuity industry. Going back to what you were discussing there, I know many people understand that getting or staying invested in the equity market is so important for a secure long-term retirement, especially during periods of high inflation that may deplete savings more quickly. Why is it that we're seeing so many retirees that are not confident to stay invested and are falling back on an asset allocation that's less conducive to their needs?
Yeah, I think, if there's one reason I would point to, just general uncertainty. I think it's very hard, especially as you approach retirement. There's a lot written on the complexities of retirement planning. I think William Sharpe called it the Nobel laureate described it as the most complicated problem in finance. That's daunting for an everyday, investor. And there's also real risks. I mean, sequence risk, the idea of the pattern of returns early, right before retirement or right after retirement, is meaningfully more important at that stage than it is while you're accumulating assets. So there are real risks associated with, your asset allocation that can impact retirement. But I think a lot of it is just the volatility we've seen in the markets and the uncertainty. And there's real cost to this. There's been a lot written on this subject, but there's all these studies that show that the average investor underperforms indexes or indices because largely they're just mistiming the market. People are not very good about figuring out when to get into the market, when to adjust their asset allocation. And there's a lot of return, left on the table as a result of being underweight in equities at exactly the wrong time. And I think that's one of those behavioral things that advisors need to think about as they're planning strategies and designing plans for their clients.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from advisor perspectives every day, so why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member, and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. So we're faced with this problem of sequence of return risks, which we've written about in our newsletter many, many times. We've got the risk of poor timing of the market. How do annuities come into play to address those issues?
Yeah, absolutely. And I think this is, one of the things that we've been focused on a lot in the last couple of years is we were focused consistently on telling the story of a sort of neoclassical economic story of how annuities add value. You can use the example of a simple income annuity, and demonstrate how much more spending you can get over retirement versus a bond ladder, essentially from the value of mortality pooling. Taking away that element of unknown time frame helps you spend more than if you did on a bond ladder. But I think a lot of our learnings in this area have been that all assumes everyone's pretty rational. And this lesson that people are underinvested in equities, as an example, is something that we feel like annuities can also provide benefit. I believe you interviewed Steve Scanlon from Equitable in the fall, and he mentioned a similar concept. We offer on our variable annuities a GMAB, guaranteed minimum accumulation benefit. Very simply, a 10-year put option. Basically, we say if you put your money in our variable annuity, for a small fee, we'll basically guarantee you get your money back in 10 years. Now, that may or may not pay off. That's the history of whether the equity markets are up or down in the course of 10 years. But interestingly, the value of that product is not necessarily whether it pays off or not. In the same way, if I have homeowners insurance, I'm not hoping that my homeowners insurance pays off and my house burns down. I'm just happy that I have that protection. And so behaviorally, what we've observed is that guarantee, that 10-year guarantee on the market, helps our consumers, those who have that guarantee versus those who don't, holding all else equal, wealth and affluence and age and gender, et cetera. Those who have that guarantee hold 15% more equity. Basically, they increase their equity allocation by 15%. And they also are half as likely in a downturn to sort of panic sell out of equities and move all into cash or into fixed income. So that behavioral benefit, even whether or not the guarantee pays off, is worth quite a bit. At extra 15%, you capture the equity risk premium. It almost pays for the value of the cost of the rider itself. And there's a lot of examples of that around annuities, but I think it's a concept we're trying to lean into, which is we've got to design solutions for how people are actually behaving, not necessarily how we assume they're going to behave.
We're going to include links to a couple of papers that you've written, one called The Deaccumulation Paradox, the other Understanding the True Cost of Healthcare in Retirement. But at least in that first one, which was very interesting, you wrote about retirees' reluctance to take money out of their portfolio, even though they have enough money, have sufficient funds to responsibly take withdrawals. Is this an area where we also could see annuities help retirees mitigate those behaviors around spending that are detrimental, that work against them in retirement?
Yeah, absolutely. And I think I'll sort of lean into this with a little bit of a story. I mean, we probably 5 or 8 years ago, we went around and we asked a bunch of consumers what rate they were withdrawing assets in retirement. Our thinking was that we were going to find a bunch of people who were spending down assets at a rate higher than the traditional 4% rule, and then were therefore putting themselves at risk. And much to our surprise, we couldn't find nearly anyone who actually said they were spending down assets in excess of the sort of income that was coming in. So people weren't spending at 4%, they were spending at 1 or 2% or whatever dividends and interest were paying at the time. And so not only did this mean that the sort of debates around whether 4% or 4.5 or 3.5 is largely irrelevant to most individual investors, It meant that those folks were basically constraining their spending because of all this uncertainty about retirement planning. And they'd learned a simple rule: don't spend more than you bring in. They were living off of dividends and interest. So in that world, the value of a guarantee helps people sort of get over that uncomfortableness about the future. And there's been a number of studies written about this now. Ebrey, J.P. Morgan, their retirement research group, have highlighted this sort of systematic underspending. There's lots of affluent Americans who are spending materially less than they could. And they've also highlighted, there was a Vanguard paper highlighting that pensioners, those who have a lot of their income in retirement coming from pensions, if you hold their wealth constant, spend more than those who are generating it out of DC plans largely. The same thing we found in terms of, there's a study or a database from the University of Michigan that has all this retiree spending behavior. And one of the things we discovered in that is that those who hold an annuity, guaranteed stream of income for life, spend about 10% more than those who don't. And really what that's doing is it's saying you don't have to worry about all that uncertainty late into retirement, in the same way that when you have homeowners insurance, you don't have to worry about your house burning down and holding all that value in cash. You can safely spend that money throughout the rest of your life. And so that's another example of kind of a behavioral point that helps people spend money. I will say, I don't think it's just annuities. It's anything that provides sort of an ongoing sort of sense of protection. So, long-term care insurance, other forms of insurance, even things that provide systematic ongoing income, get at the same thing and help people have the confidence that checks are coming in, money's coming in, I can safely spend more.
You mentioned long-term care insurance, and I did mention that you have a paper that we've got a link to, Understanding the True Cost of Healthcare in Retirement. How should retirees be thinking about healthcare costs that they may face in retirement? For example, how can they weigh the risk of a healthcare shock against longevity risk into their portfolio in retirement?
Using the same database I mentioned with all this longitudinal data on spending, we looked because lots of folks, you ask them what their number one concerns are in retirement, and oftentimes people will say healthcare inflation, rising costs of healthcare, et cetera. So we wanted to understand how that showed up for everyday retirees. And the conclusion was interesting. On average, healthcare expenses are about 15% of retirees' spending. So it's a meaningful percentage, but it's not anywhere near as large as, say, housing costs in retirement. And it's actually, for most, quite predictable. Most healthcare expenses in retirement are insurance premiums, Medicare, premiums, et cetera, and it's actually relatively predictable. So one of the conclusions from this is advisors need to make sure that their folks moving into retirement have a plan around healthcare and aren't being sort of overly worried about it. Like, as long as you have a plan, it's actually pretty predictable. The other conclusion was healthcare expenses are predictable for most, but highly volatile, especially later in life. So nursing home costs, home healthcare costs are material expenses for a relatively small percentage of the population. And so, one of those things I mentioned, those with long-term care insurance tend to spend more than those who don't. One of the reasons for that is they've got that protection against something that could be highly volatile late in life. Those who don't basically need to sit on this kind of pile of assets to prepare for it. And so, the conclusion there largely is advisors should be having these conversations around healthcare expenses, but also know that a lot of the concern around healthcare, it's a significant expense, but it can be sort of managed and predicted, with some certainty.
If there's one key takeaway that you'd like to leave with our audience of advisors about how they should position annuities to their clients, particularly given the market and economic environment that we face, what would that be?
Yeah, I think, in line with the conversation we've had here today, our conclusion largely from a lot of our research is we want to design retirement plans, inclusive of annuities as a tool in that toolkit, along with traditional assets, but design those plans with respect to how we expect folks to actually behave, not necessarily how economics tells us they will behave. So as I mentioned, we shouldn't necessarily assume that everyone's going to stay 60-40 week in and week out through the worst of crisis and the like. We need to sort of plan for what happens if they panic sell out of that. How do we prevent them from or help them to holding an ideal asset allocation. Or we shouldn't assume folks are necessarily going to spend down at 4% every year. We've got to figure out what are the tools to help them spend it at a rate that they can, that may bring them greater joy and happiness in retirement. So the overarching thing I would say is there's a lot of uncertainty out there. There's an awful lot of retirees and pre-retirees really approaching retirement. The need for financial advice, I think, has never been greater. But we should design plans and solutions around, the realities of how people actually live, and annuities can play a powerful role in that.
Well, thank you. And we'll include some links in the notes that accompany this podcast where you can learn more about Todd and what he does and about New York Life and its suite of products. There'll be a link to the New York Life Annuity website, a link to the New York Life Annuity page on LinkedIn, and then the two papers that I mentioned earlier that Todd has authored, one about decumulation and the other about healthcare and retirement. Todd, is there anything else you'd like to add?
No, I'll just reiterate what I said a second ago, which I think it's a very challenging environment out there for a lot of folks who are in and around retirement. And, I give kudos to all the advisors out there working with them. I think it's an incredibly challenging environment, but, I'm confident we've got the folks to help people properly plan for retirement.
Well, thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Todd Taylor of New York Life. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.